In this lesson, I'd like to talk to you about how federal income taxes are structured in the United States of America. In the United States, income taxes are used to collect revenue for government activities, but also to shape public policy and promote activities that benefit society. Clearly, the place to start is with some definition of income. Taking the broadest idea of income, it is any activity that increases your total wealth. Here is a basic formula for how the U.S. government calculates income tax. All income minus excluded income equals gross income. Gross income minus adjustments equal adjusted gross income, or AGI. AGI minus deductions and exemptions equal taxable income. Taxable income times the tax rate equals taxes owed. And finally, taxes owed minus credits equal taxes due. Exclusions generally fall into two categories: income that is unreasonable or impractical to monitor, and some matter of public policy. Exclusions are changes in wealth that do not appear on your tax return. Generally, you are not required to report them to the IRS. For instance, if an insurance company reimburses you for the loss of your car, that payment is not considered an increase in wealth. The payment is for pain and suffering. Proceeds from life insurance are not taxable on those same grounds. An increase in the value of your home is unrealized income and is not taxable until you sell your home. Any attempt by the government to monitor all gifts would be impractical. However, large gifts are taxable to the giver under a separate system discussed in the estate planning lesson. In the area of public policy, many employee benefits, like retirement plan contributions and medical insurance, are not included as income on the W-2 form that companies prepare to report your compensation. Although tax-exempt bond income is reported on your 1099 and required on your Form 1040, it is also excluded. This policy is in place to help state and local governments raise money at a lower cost. Miscellaneous items include things like scholarships. Here we have the major categories of income contributors. Business income is income minus expenses necessary to produce the income. Rents are similar to business income. You'll note that unemployment compensation is taxable income. Alimony is taxable, however, child support is not. Social Security, however, is partially taxable, as are pensions and annuities funded totally or partially with before-tax dollars. This means money that you put in on a pre-tax basis. Adjustments are another way of subtracting out expenses to help reduce a person's taxable income. This is similar to how a company would calculate its net taxable profit. But say for people that are self-employed, the government allows them to exclude their medical insurance payments, retirement plan contributions, as well as employer share of Social Security and Medicare taxes, because essentially they're paying both sides of the employee and employer's share of that. Moving expenses, student loan interest, and IRA contributions would also fit in this category. Because AGI is a creature of the tax code, its components have changed over the years with tax law changes. Your AGI is your income minus deductions. It determines which tax bracket you're in, but also tells you which credits you qualify for. AGI is used as a measuring stick for various public policies that are currently in the tax code. Once adjusted gross income is established, we move into the actual computation of taxes. But first, we need to determine the filing status. The tax code establishes 5 different categories of personal taxpayers. The names are fairly descriptive. In general, you can think of the head of a household category as a single person who has dependents. Widows and widowers are eligible for this status the year after their spouse's death. Now, in general, tax policy assumes that there are certain basic costs associated with living that should be paid without having to be taxed. Thus, there is an exemption amount for either an individual or each member of a household. There are also standard deductions for each of the various kinds of filing statuses. The remainder deductions, however, are generally used to shape public policy. Itemized deductions are available to those tax units that have expenses that exceed the standard deduction. High among these for many Americans is the home mortgage interest deduction. This is a clear attempt by the government to encourage home ownership, also known as the American dream. Medical expenses in excess of 7% of AGI, or again the adjusted gross income, are meant to assist people with unusually high medical bills. Charitable deductions are available to encourage people that want to donate to a charity. Now, some state deductions are deductions on the theory that income should not be taxed if the income is already taxed by another entity. This is a particularly debatable point since, let's go back to that slide actually. This is a particularly debatable point because there's examples of double taxation that already exist in the tax code. The miscellaneous category includes things like tax preparation and unreimbursed business expenses. Tax rates will be handled in the next video, but for now you should note that each of the types of the tax-paying units or filing statuses have their own schedule of tax rates. Tax credits are another area that are used to shape public policy. A credit is a direct subtraction from taxes owed and therefore is much more appealing to the taxpayer than a deduction. Most tax credits have not lasted very long and they are instituted to have a specific economic impact. In recent years, tax credits have focused on improving the plight of families with relatively low incomes.